Hello, welcome to today's webinar on the topic Working Capital Trends in Europe, a look into 2021 and beyond. Okay, so first of all, let me introduce myself and then Ernesto will introduce himself. I'm Emilio Della Bruna. I'm a principal at Officio. I have 13 years experience across procurement and supply chain work on both on the strategy and the transformation side, including projects involving working capital optimization on inventories, optimization side, payables and receivables as well. Ernesto, pass on to you.
Yeah, hello, good afternoon. My name is Ernesto Muñiz, and I'm a working capital specialist with 30 plus years of experience in consulting, mostly delivering working capital improvements across many sectors, industries, and geographies.
Thank you, Ernesto. So just quick introduction of Officio, who we are, what we do, and then we move into the topic. So we are a global procurement and supply chain consultancy. We have more than 600 professionals across 13 global offices. So very diverse, and we are known by delivering measurable results and with expertise knowledge on specific categories. And we are also known by being very hands-on on our delivery, working partnership with our clients. And yeah, so that's really just a quick overview of who we are, and so we get to know Officio a little bit more, and you can see more details in our website. So then today we're going to be talking about the output of an analysis we've done on 1,905 companies in Europe, and we look at their financials for the year of 2020 and 2021 to understand what was the working capital performance in that sample, how that is affected by the current economy, and how that is affecting the economy in Europe in general. So this is what we'll be covering, and the objectives specifically to our session today is first to give you an understanding of the latest trends in Europe, as I mentioned. We also want to provide more clarity on how those trends vary by sector. And we're going to deep dive into 3 selected sectors. We also want to talk about how the inflationary pressures, the latest economic developments will or might affect cash flow in the future. And finally, we are gonna talk through the key actions that firms could take to be better prepared for any economic outlook that is ahead of them. All right, so now let's get into the interesting bit. And I would like to invite Ernesto to talk a little bit more about the overview of our research. What are the key insights when we look at Europe as a whole?
Okay, yes, as you can see, the overall trend has been an increasing one for several years now. Slowly, in the initial years showed in this chart, as you know, low interest rates allowed companies to postpone the difficult decisions on working capital management, but more sharply in the past 2 years, when the disruptions caused by the pandemic have been more prevalent, and components crisis have also kicked in impacting a number of sectors. Just a clarification, on the calculations, you're probably all aware, but I'll repeat it just in case. DPO, DIO, and DSO are calculated dividing the corresponding payables, inventories, or receivables at the declared year end of these companies by 1 day of COGS for payables and inventories, or sales for receivables. And the cash conversion cycle, which you can see on the left, is the aggregate of the assets minus the liabilities, DSO plus DIO minus DPO. And as the graph can see, and we'll see in a number of slides after this one, the main element impacting this sharp increase from 20 to 21 has been the growth in inventories across many sectors. So that's, you know, at a glance, the high level trends, and can probably look.
Yeah, Ernesto, thanks very much. And it's quite interesting, right? How the inventories are playing a big effect here. And I think my next question on that is it something that you're observing across all sectors in the economy, or how does it vary by sector?
Well, if we go into the next graph, we're going to see all these variations that you can see by sectors. In this graph, you can see we've split these companies into 21 different sectors, and you can clearly see the number of days that they declared as cash conversion cycle at year end, from 274 in aerospace to minus 24 in telecommunications, which is a factor of the different types of business models to start with, irrespective of the impact of the pandemic and of the current situation. The different sectors will have different needs of cash invested in the production cycle. You know, and typically, if we look into aerospace, we're going to find that aeroplanes take a long time to build, very high inventories in work in progress, which are typically financed with period payments, but overall they take a long time to to circulate. On the other end, we can find, for instance, media and communication, where you can see very low inventories overall and much faster payments associated to services rather than goods. So just to start with, we're going to find all this diversity, and on top of it, the elements of the economy have had a different impact, and you can see the winners and the losers depending on whether they are green improving or blue deteriorating.
Yeah, that's interesting, right? You mentioned aerospace, so hugely affected by the reduction of global travel due to the pandemic, and you can see that through worsened inventory levels. So that's quite interesting.
Oh, definitely. A lot of companies put on hold or even canceled orders that they had because they were not needing, the airplanes. Actually, they were grounded for many months. So this has had a strong impact, even more. And as you can see, aerospace in light blue is one of those that has gone up quite high in from 20 to 21. If you count them, there you can see that there were more sectors for the sample of companies taken here in this study, more sectors that did improve than deteriorate, but the high impact of those that deteriorated definitely tilted the balance into an overall deterioration for companies in Europe, as you can see. So it's not a rosy picture, one can say.
Yeah, indeed. And we prepared a deep dive on 3 of these sectors, where we want to go into more details about why why we observe those variations in the performance. So Ernesto, shall we get into the first one?
Yeah, no, absolutely. Which, if I remember, is Automotive. Yeah, and which has been, in the front pages of many economic and non-economic newspapers and publications because of the semiconductor crisis, putting a stop to production lines, which is something that has been happening during 2021, and it's still ongoing. So there's still some more to come probably on this sector. And the clear impact here, as you can see, is a high increase in inventories, as unfinished vehicles are left, and their components and their spare parts and all the related elements are left on stopped or slowed down production chains. So it's a typical sector where we can see this strong impact. Luckily for
yeah, go ahead. Sorry.
No, I was going to say that luckily for many of these companies, and you can see here the weight of the OEMs, you can see improvements on both ends of the supply chain, as increasing days on payments to suppliers, reducing days on payments from customers. So one can tell that they have been able to get a certain level of financing from, willingly or not unwillingly cooperating partners on both ends of their supply chain.
Yeah, it's a lot about the negotiation power that a company will have in their supply chain, right?
Yeah, absolutely.
But they also need to be considerate of their suppliers and clients, because they might not have suppliers or clients in the future if they push too much on those elements.
No doubt. And one, has to always be able to balance the how short-term actions that may be required cannot be sustained for a very long time, and you need always to go for structural changes rather than maintaining time, very short time remedial measures, like delaying payment to suppliers without having negotiated those new terms.
Right. And what other things like the companies can do to revert this trend, for instance, on an inventory side?
It's on this element, a typical thing that we see here and in other sectors is pilot the mid to long term look what components may have the highest impact in releasing unfinished products, and secure the supply of those elements. So, build some sort of control tower that would give you visibility on what has an impact in the highest impact on your inventory through a proper segmentation, and thus allow more impacting actions, help you release these, what has become slow moving that wasn't in the past.
Right.
And of course, you need to have a very tight relationship with your suppliers and also your customers, but mostly with your suppliers in this case, to ensure that you come close to the top when they are, making deliveries of what are key components to you.
Got it. All right. Shall we move into the next sector, construction engineering?
Yes, that's one that has been hit hard. And as you can see, the increase in days here has been even more remarkable than in the case of automotive that we just saw. They have suffered the double evil impact of shortages in the supply of materials, rising prices, Even if construction did not stop during the pandemic, it has always been deemed a sector, a priority sector. So it went on, but as disruptions started to impact this industry, companies often hoarded up inventories to secure more of certain materials at a certain price to avoid having to increase prices and having to relay those to customers, which is not always possible, because if we're talking about public tender that you have won, you just have to go for a price that you committed to. So that has had the double impact of shortages on the one hand, but also very high inventories on the other hand to mitigate those potential and actual disruptions. So this has been very serious here, and as you can see, also given the size of many of these companies, they haven't had the luxury of being able to extend payments with suppliers. They often had to even pay faster to secure that supply of goods. So this has been a sector strongly impacted, and these will have to be looked carefully into what are you ordering, how you are stocking it up, how you are securing supply while not having too much of everything that you may then not be able to use.
Right.
Of course, sorry, I was going to add, of course, with the recent added disruption of the war, some of the key materials are also, in higher demand. So we still need to see the full impact of that.
Yeah, this sector is not really facing an easy time recently, right? With the pandemic and now the war in Ukraine disrupting their supply chains. It seems that's being a tough time to manage cash flow.
Yeah.
And another, sorry, want to add?
I didn't have any more to add about this particular sector.
So let's talk about another sector that was also very affected by the pandemic, and now again by the current geopolitical situation in Europe, just food and food products and services. So could you talk more about that one, Ernesto?
Yeah, absolutely. And this is a sector, as which you can see has been not in bad shape coming out of the pandemic period. Again, even more basic and protected during the bad times. This activity did not stop. So in 2020 and 2021, they were able to improve working capital positions, mostly from a reduction on inventories. Goods were in high demand, often of not a long shelf life, so you really need to be able to rotate them. So companies have been able to manage the situation, improving their working capital, and also through payments, short payments, fast payments from customers willing to get the hold of those goods. So that has been a good situation. It can quickly evolve into, okay, how far can I go into these reductions? Is the present situation likely to have an even more serious impact, and I run out of goods and that would be a perverse effect. It's a possibility. It's a possibility in the present times. One has to avoid those bad type of reductions. And I would say, if you ask me what these companies can do to improve, keep on improving working capital, or at least maintain the gains, is you know, a strong focus on projected availability of supply and supplier reliability, and factor those elements into the rules governing the replenishment process, so that you are able to, you know, through proper management, ensure that you work at reasonable levels of working capital, and particularly of inventories. So this has been the main element to look into, because it's still, and it can be problematic, but you know, you need to do your homework in the way you manage internally. So I think.
Yeah. Thanks, Ernesto. Sorry, I was on mute on my end. I don't know if you want to add something else. Yeah.
Yeah, no. I was going to say that we have pretty much covered, you know, this high level. We cannot go too much into detail because I'm conscious of time, and
yeah,
talk for hours on this topic. But having covered these three sectors, we can then turn into a different topic, which is related to the cost of debt, which is also a source of concern.
Yeah, exactly. I can cover that one. And so basically, so far we've been looking at the data of and what happened in the past, right? This is next one is a little bit about what we see that might happen going forward. So we had a look at the data set and tried to understand how much debt the companies took to finance this additional working capital requirements, and how that compares to the revenue levels. So if you see on the left-hand chart, you can see the total revenue for the sample reducing in 2020 compared to 2019, and then increasing again to barely recover from the pre-pandemic levels, whilst the total debt, which is the light blue bar, has been growing increasingly, and by pretty much almost 50% since 2019 to 2021. So a lot of this having this additional debt has been used to finance additional working capital requirements, such as additional stock levels. Of course, there's also the fact of that companies have additional costs to run, additional controls defined by the pandemic. But it's a lot related to working capital requirements, and that was really possible because the interest rates were very low. There was access to capital. The governments were making it as easy as possible for companies to access capital and keep going and keep the jobs and be ready to come back after the pandemic. However, with that, we also saw a huge inflationary pressure, right, on utilities, on raw materials, and labor. For instance, truck drivers is in shortage across multiple countries. And because of that inflation, the central banks are now looking into increasing their interest rates. And we've seen some already doing this, like the Central Bank of England increased the interest rates a few times this year. The Fed is looking into doing the same. So because of that, basically this access to capital will be more expensive going forward, and that will put pressure on companies to pay back the additional debt they contracted and keep financing their working capital requirements. So we anticipate a challenging time in terms of cash flow management on the working capital side for the companies because of that economic outlook that we just described here. And what we want to talk about is really what companies can do to be better prepared for that, to not get into trouble in this challenging situation. Ernesto, if you want to add any comments here before we get into the recommendations.
No, actually, I was going to comment actually on how what are the suggested actions that company can take to address these situation and this potential scenario that is not going to be so working capital friendly in the foreseeable future.
Right. So let's have a look at those. So these are the few, let's say, quick actions that we believe will, be easy to implement to some extent, and also better protect the business on terms of ensuring cash flow going forward. So we separated them into the payables, inventory, and receivables elements. And let me start with the payables one. So on the payable side, for us, what we observe is that many companies, they extend the payment terms regardless of whether they negotiated that with the suppliers in the last year or 2 years. So now what they can do is to actually come back to those suppliers and say, look, we've extended these payment terms. Can we consolidate this new payment terms going forward to make it sustainable now as a business? And some suppliers will allow that because basically they might not be so strained in terms of cash requirements. On the other hand, when not possible, you could use that to leverage, to negotiate discounts with them. So saying, okay, I'm gonna revert back to the original payment terms, but we agree on a certain discount on pricing based on cost of capital. On the inventory side, what we suggest is to have a look at the inventory mix, understand which items are now sitting in stock and are slow movers or will soon become slow movers or obsolete items, which items are critical and might be under risk of supply, and really set your inventory policies to protect against supply chain disruptions, but at the same time getting rid of the item that you no longer need. And that might require some cross-functional coordination within the business, but that's key to make sure you have the right items in place going forward. And then on the receivable side, it's all about making sure that you collect the cash from those clients that for which payment terms were extended temporarily due to the pandemic, making sure you proactively collect payments from especially the higher risk customers that are in your balance sheet at the moment. So these are, let's say, our no-brainer actions that every company should be doing to be in a better position, as quick as possible. And I think what we could share on top of this, let's say, practical actions is really some examples of how when we apply that, and then the challenges and advice on how we deliver that. So I'd like to ask you, Ernesto, if you have some good examples that we could use to illustrate those actions.
Yeah, definitely. I mean, the last one you mentioned reminded me of a project in which I was involved not long ago, where a company manufacturing loudspeakers and that had a strong business sector on the loudspeakers in the live concerts that, of course, were totally disrupted during the pandemic. And the way that they have to be very tolerant with the companies organizing the live tours on paying for their debt, because their business totally stopped. Now, as business has been restarting, they have agreed to negotiate progress payments to ensure that they come up back to where they were before the pandemic in a way that secures ongoing business, ongoing payments from their customers, but without, making sure that they don't keep on increasing their debt, but not disrupting totally the business. So that was a very sensible approach that was achieved and has been working pretty well.
Right.
If I think on the payable side, yeah, I remember another project. This was a European packaging group that had longer terms than average. It's actually on a number of sectors, and shorter terms in this case, and they had to be extended. And one way that this was achieved was not through the easy thing, which is delay payments. That's never the appropriate approach. You really have to do it in a concerted manner. So central negotiations from central procurement allowed them to reduce the number of terms that they had with each supplier, and going always for the longer one with negotiated centrally by the group and applied across all the subsidiaries. So this helped a lot, standardizing on the upper end, and also benchmarking by categories. Let's say, let's address the logistics suppliers, let's address the materials, cardboard or ink. What can we see in this sector are the normal terms in which these companies get paid? So looking at the other side is, what is the DSO of these companies? How well are they being paid? And how am I paying in comparison? And we discovered that this company often were paying faster than those same suppliers were being paid. So these allowed for negotiations and agreements on longer terms. Again, always through negotiations, always through a concerted approach, not through pushing terms in a I just stop paying or pay late, which doesn't lead to very good long-term relationships. So
Yeah, exactly. I think payables is something you need to see as part of your procurement approach, right? It's one of the levers in your relationship with your supplier. So you need to really use that as one of the levers in the table. You also have price, you have your service level, you have many other aspects of the contract that you should bring to the table. So if you do that wisely, you can make extend the payment terms as smooth as possible, really.
Yeah, absolutely. That's it's always a comprehensive package that you should look into when you negotiate. Not just you can go by price, and sometimes that will be the main driver. But in general, there are many other elements that have to be looked into. That go with the quality, with the reliability of supply. Yeah. And then one of those elements should be the terms, the most appropriate terms for the type of good or service being delivered. Yeah.
Right. I'm conscious of the time, and I do want to allow time to answer the questions from the audience. So thanks, Ernesto. These are very good examples, and we can bring a few more based on the questions we've got.
Yeah, absolutely.
So let's switch to the Q&A section. So we've got some questions when people submitted the subscription to the event. Let's start with those, and then we can also cover the questions that people are sharing live today in the chat or the Q&A button. And thanks a lot for those questions. They're really good. So let's start with the first one. It is how to optimize inventory when everybody is just about or working on just about a material availability. Do you want to take that one, Ernesto?
Yeah, definitely. And it is something impacting a lot of projects I am currently doing, where there is a serious concern about material availability or actually semiconductors, nonetheless. But of course, the answer, a simple answer to start with, is of course segmentation. You need to look into the inventory with the appropriate level of granularity to differentiate with those SKUs with very high demand and or supply issues, where safety stock will be key. You have to make sure that if they have to be high, they will be high. So those really need to be the bulk of your investment in inventory. But there will be many other SKUs that you identify as slow moving, even obsolete. Many elements that items that you really don't need to keep so much in stock, and that you can delay deliveries, reduce levels of inventory, definitely minimize safety stocks, get rid of those some of those obsolete items through concerted actions. There are many things that can be done depending on the cases, but the key is to have enough level of detail and insight through, as I said, segmentation of your stocks.
Right. Okay, thanks. Another question is, what is the best Brax cash conversion cycle by country, considering the different legal and business practices? So I can cover that one. And then feel free to add, but basically you have to look at best practice from an industry perspective and the country perspective. So each industry will have their own business model, as Ernesto illustrated very well in our slide where we showed all the sectors in our research. On the other hand, countries will have specific rules about how long payment terms can be. And also there's an element of culture as well on how much credit they want to give and receive. So of course that affects both DSO levels and DPO levels. So if you have a country that limits payment terms to 30 days, you're going to have lower DSO levels, but on the other hand, you're going to pay your suppliers up to a certain up to 30 days. So it compensates on one side and the other. And you really need to understand what's the regulation for that specific country through doing some research. If you're getting to a new to do business in a new country, you need to do some research on that. And there are also some benchmarks around, and you can use as a reference.
Yeah, no, absolutely. I mean, it is a factor of legislation, definitely, but also being aware of the circumstances, that sometimes even physical circumstances of a country, because if you need to deliver overground goods that will have to take through a road or rail network that is not reliable, and you can think countries that not in, if we think of Europe, most of them will not fall within that picture, but you have bad weather, you have winter, snows, all that type of things happening, and all those things have to be considered when you are looking into what could be the optimal, and definitely adapt and not take a standard approach thinking that, okay, what is done in Germany can be applicable without any type of difference to Italy or Spain. Yeah, certainly.
Thanks. Yeah, and there's another question on what are the major drivers for companies' working capital performance in the recent years. I think we touched some of these points during the presentation, right? It's been a lot about protecting your inventory against disruption by sometimes buying bigger batches, buying beforehand, and it's being about paying shorter payment terms to ensure that you're gonna get the priority from the supplier to deliver the orders. It's been about providing extended payment terms to some clients that might be struggling to pay you back, so you keep them alive for the future. So there having a few elements here. I don't know if you want to add a few other on your side, Ernesto.
Yes, I related to what we were just saying about the cost of debt. Recent times have been easygoing from a working capital perspective for most companies. So this has not been the priority. Let's be honest, it hasn't been the major focus, except for some individual companies that may have experienced issues. But now we're running into not such an easy scenario where you have to balance disruptions with, stringent cost of capital conditions, and there are a number of structural actions that have to be looked into, because this is going to be the major driver going forward. That every euro invested in working capital will cost companies more, and will have to be better evaluated.
Right. Yeah. Makes sense. There are two questions from today in the Q&A box. So regarding the data of our analysis. So there's a question: what's the criteria that we used for the research? Why 1,905 companies? So this is basically the sample of all listed companies that had reported their numbers by mid-January when we run the analysis. So we try to have as a broader sample as possible without losing too much time to be able to produce some results from the last year, right? So this is something that we run on an annual basis, and we're now focusing on producing a report for North America, so it should come soon with refreshed data. So keep an eye on that. That's the criteria used. And there's another question on DPO benchmarks and where to get good material categories benchmarks. So as Ernesto mentioned, easy way, let's say, of creating your DPO benchmark against your supplier sector is looking at their receivables days, right? Their days of sales outstanding, because this is on average what they typically have with their clients. Of course, there are cases and cases, but it's a good starting point. And if you want to know specific benchmarks for certain categories, feel free to reach out to us. You have my email address here in the slide. We'll be happy to discuss, about your specific needs on that one. Good. Conscious of the time, we just on the time, but let's cover maybe a final question before we wrap it up. There is a question on how long it takes for or what's our approach and how long it takes for us to conduct an analysis, like meaning a physio. So what we usually do is we do an opportunity assessment phase where we get the data, we look at your data, understand the cases of the suppliers, understand your internal processes, and that takes from 2 to 4 weeks, which depends on of course the scope of your businesses. If it's a global business, might take longer. If it's like a local business, it will be quicker. And after the opportunity assessment, we have a very clear view already on cash that can be released through certain levers and how long it's going to take to deliver that. And after that, we then kick off the real implementation of the value. So we, designing the future processes, the policy that is going to be put in place in terms of payment terms, credit management, etc., and implementing that across the organization to make sure that cash is released tracking the achievement of that opportunity that was initially identified. So that program might take longer, right? Because working capital does require some fundamental changes in the way the organization works. So a program could take from 3 months to up to 9 months to a year, depending on the complexity. But it also, it depends on a few factors that are assessed during the opportunity assessment. And if for any other questions, really reach out to us, and we'll be happy to cover them. There were a few more questions in that session, and we really appreciate that. But maybe they were a bit more like focused on certain regions and sectors, and then we prefer to cover them individually to maximize the information that we provide to the audience today. Okay. Well, thanks very much, Ernesto. It's been great to have you in this conversation. Hope everyone appreciated the webinar today, and feel free to reach out.
Okay, no, thank you, Emilio, for the opportunity to share some thoughts and ideas and on working capital management and opportunities for improvement across different sectors in Europe and further away, of course. So looking forward to the next.
Exactly. Everyone have a good day. And thanks a lot for your time and for your attention.